Okay, let's dive in. So imagine learning really sharp, practical investment strategies, not from some, stuffy textbook, but inspired by a Netflix show.
Yeah, like The Residents. It sounds a bit wild.
Exactly. But that's the core idea in the source material you sent over. It's an article called Practical Investing Strategies Inspired by the Netflix show The Residents by Sir Margin of Kumo Solutions.
And it's actually quite clever how the author connects these themes from the show, power plays, scandals, long-term versus short-term thinking, who has the best info.
Right.
And translates them into actual concrete things you can do in the market.
Totally. So our goal here isn't just to recap the article. We want to really unpack it together, pull out the most important bits, the practical stuff you can actually use for your own investing. It's using the show's drama to shed light on real market stuff.
It's a unique way to look at it, definitely. It frames these complex financial ideas within a story, which can make them, well, easier to grasp and maybe more memorable than just reading a dry guide.
Yeah, cuts through some of the noise. Okay, so let's jump into the first big lesson the article pulls from The Residents.
Okay, lesson 1 is all about power dynamics and influence. The article basically says, just like in the show where people with connections or, let's say, insider knowledge kind of shape what happens, certain players have a huge influence on the real market too.
And the takeaway for investors is to recognize this and maybe follow the smart money. What does that actually involve?
Well, it means watching what the big institutions are doing, the huge funds with all the analysts. You can get clues by looking at things like 13F filings.
Ah, the 13F.
Yeah, they show what large investors, like Buffett's Berkshire Hathaway, are holding. It's public info required by the SEC, though there's a delay.
So not quite insider trading, but insight into where the big money is moving. And the article also mentions watching corporate insiders. The executives.
Absolutely. SEC Form 4 filings, they show when insiders buy or sell their own company's stock, if the CEO is buying big. That often signals confidence.
Makes sense.
Yeah.
And heavy selling could be a warning.
It could be. And beyond investors, the article really stresses the power of central banks, like the Fed.
Oh, definitely. Their decisions impact everything.
For sure. The article points out, when the Fed cuts interest rates, it usually helps stocks, especially growth stocks. But if inflation's high, things like commodities, gold, oil, or inflation-protected bonds, TPS, tend to do better.
So a practical step from the article is maybe setting up alerts for Fed meetings, hedge fund filings, using tools like Bloomberg or even Yahoo Finance.
Exactly. It's just acknowledging that there are major forces at play. It's not all random.
Okay, so that's the power angle. But the article also flips it. What about when things go wrong? Like scandals.
Right. That brings us neatly to lesson 2.
Which is about avoiding what the article calls house of cards stocks, inspired by scandals in the show.
Precisely. A big corporate scandal or just bad governance can absolutely wreck an investment. The article lists some red flags to watch out for.
Like what kind of flags?
Things like aggressive accounting, the classic Enron example, hiding debt. Or maybe a CEO suddenly resigning with no good explanation. Think Wells Fargo and the fake account scandal.
Okay.
Excessive debt is another one, like Lehman Brothers before the 2008 crash.
So how do you spot these? The article mentions forensic tools.
Yeah, basically doing your homework, like checking out reports from short sellers. Hindenburg research is mentioned. These guys are betting against the company, so they dig for problems.
Their research is biased, obviously, but it can uncover things.
Definitely. And another key thing is comparing reported earnings to actual cash flow. If a company claims big profits but isn't generating cash, that's a serious warning sign, a big discrepancy.
Okay, so the action step here for you, the listener. Before investing, actually read the company's annual report, the 10K. And do a quick search for lawsuits or regulatory issues. Don't just trust the hype.
Sound advice. Now, moving from avoiding disasters to building success, the article looks at long-term thinking versus reacting to chaos. Lesson 3.
Right. Long-term planning versus short-term chaos. Be the tortoise, not the hare. The idea that impulsive moves based on market noise lose out to patient strategy.
Such simple advice, yet so hard to follow sometimes. The article really pushes dollar cost averaging, DCA.
Explain that quickly.
Sure. It just means investing a set amount of money regularly, say $500 a month into an S&P 500 index fund, like an ETF. You do it whether the market's up or down.
So you average out your purchase price.
Exactly. And the article makes the point that historically, this beats trying to time the market perfectly. It removes the emotional guesswork.
And they bring up compound interest, too. That powerful example.
Yeah.
$10 K at 10% annually becomes over $67,000 in 20 years.
Yeah, without lifting a finger, basically. It just highlights the power of time and patience, which leads to the next point, ignoring the noise.
Don't react to scary headlines on CNBC or get sucked into hype on Twitter.
Precisely. That short-term stuff is where people make impulsive, often costly mistakes.
So the action step is automation. Set up regular investments into low-cost funds. The article mentions VOO or VTI as examples. And then critically, don't check your portfolio every 5 minutes.
Pretty much. Set it, automate it, and let it work. Now, building on that strategic idea, lesson 4 is about adaptability.
Adapting to change. Like characters in the show pivoting during a crisis, investors need to adjust to economic shifts. Rotating sectors like a strategist.
That's the phrase they use, sector rotation. It sounds fancy, but the article breaks it down based on the economy.
Okay, how so?
Well, the idea is to shift your focus. Like, in a potential recession, defensive stocks, utilities, healthcare might hold up better.
Okay.
When the economy's picking up, maybe cyclicals like tech or consumer stocks lead. And if inflation's the big worry, maybe commodities like gold or energy are the place to be.
And the article gives signals to watch, like an inverted yield curve.
Right. An inverted yield curve where short-term bond yields are higher than long-term ones sometimes signals a recession ahead, because bond traders expect future rate cuts.
Interesting. Well, so
Falling unemployment usually means a strong economy, maybe good for growth stocks. The ISM Manufacturing Index is another one they mention, a gauge of factory activity.
So the practical advice is to check these indicators, maybe quarterly, like the yield curve, the ISM index,
Yeah.
and use them to potentially tweak your sector exposure.
Exactly. It's about making informed adjustments based on the bigger picture, not just guessing.
All right, that leads us to the final lesson, number 5. Information asymmetry. Having an edge.
Yeah, back to that idea. In the show, Better Intel Wins. The article argues it's similar for data-driven investors. Getting an edge, legally, of course.
How do you do that legally? The article mentions alternative data.
Yes, looking beyond the standard financial reports. Things like tracking credit card spending data. MasterCard's Spending Pulse is an example, might give early clues about retail health.
Or job postings. Like if Tesla starts hiring tons of engineers.
Could signal growth plans, right? Before official announcements.
What about sentiment analysis?
That's another one. Using AI, maybe even ChatGPT, as the article suggests, to analyze the tone of earnings calls. Are executives sounding bullish or cautious?
And checking social media, like Reddit or StockTwits.
The article mentions it, but with a huge warning. You check those platforms for retail trends, fine, but always verify with fundamental analysis, never just trade on hype alone.
Crucial point. So the action step is exploring platforms that offer this kind of alternative data. ThinkNum or Koifin are named.
It's about broadening your information sources, potentially seeing things others miss.
Okay, so those are the 5 big lessons.
Yeah.
But the article goes further, right? It gives a sample portfolio.
It does. It lays out an example structure, kind of bringing all these principles together. It's framed for a moderate risk investor, thinking 5-10 years out or more, and uses some fun analogies from the show.
How's it structured?
It starts with a core, 60-70%, the foundation or shock absorber. This is broad market ETFs like VTI for U.S. stocks, VXUS for international. Exactly. Avoids that scandal risk of being too concentrated. Plus, a bond ETF like BND acting as a cushion.
Then there are thematic holdings, 20-30%.
Yeah, this is where you rotate like a strategist. Sector ETFs like XLK for tech, XLV for healthcare, and inflation hedges like GLD for gold or XLE for energy. You adjust these based on the economic outlook like we discussed.
And satellite holdings, another 20-30%.
These are the high potential opportunities, the power players, maybe some individual blue chip stocks like Apple or JP Morgan, powerful companies.
Okay.
Maybe some growth stocks too. SMCI is mentioned for AI exposure. Also alternatives like REITs for real estate VNQ or PLD examples, and even a tiny slice like 1-3% in a Bitcoin ETF like IBIT called digital gold for its potential asymmetric upside.
Interesting mix. And the last bit?
10% for cash and tactical. Liquidity is power, the article says. Cash in a high-yield account or a money market fund like SWVXX. Plus a small buffer for short-term moves, maybe buying a dip in a good company like Meta after earnings or reacting to global events.
So it's not just the holdings, but rules for managing it.
Yes, key management rules. First, quarterly rebalancing, selling some winners, buying some losers to get back to your target percentages.
So risk in check. Second,
sector rotation, tactically shifting maybe 5-10% between those thematic sectors based on Fed signals or economic data.
Third, Scandal avoidance. What's the rule?
Pretty blunt. If a company you hold gets into serious trouble, SEC investigation, major misconduct, dump it, cut your losses, don't get emotional.
Makes sense. And fourth,
DCA religiously. Keep making those regular automated investments, especially into the core holdings like VTI and BND. The article suggests maybe a 70-30 stock bond split for those additions.
and they give an example scenario, like 2024 recession fears.
Yeah, to show how it works. Step 1. If recession looks likely, maybe trim risky tech, XLK, by 5%, move it to defensive healthcare, XLV, and gold, GLD.
Step 2, pause new stock buys, build up cash, more liquidity.
Exactly. Step 3. Wait. Be patient. Then, if there's a market drop, use that cash to buy quality stocks cheaper, like maybe grabbing Apple 20% lower.
And it lists tools to monitor all this. Fed calendar, yield curve, stock screeners like FinViz, alternative data platforms.
Right. It really ties it all together, from the show's themes to a practical plan.
So wrapping this up, what's the big picture for you, the listener? This deep dive, using the article inspired by the residents, it shows that investing isn't just luck, right?
Not at all. It's about having a strategy, being disciplined, adapting, using information smartly, being a strategist, not a gambler.
And that sample portfolio provides a concrete example, a framework for how you could apply these ideas for moderate risk.
Yeah, it shows one way to combine the diversification, the rotation, the risk management.
And this is the really key takeaway the article hints at, the final provocative thought. That specific portfolio, it's just an example.
Exactly. The real power, the true strategic edge, comes from taking these underlying principles, the lessons about power, risk, patience, adaptability, information,
and tailoring them to your situation, your risk tolerance, your goals, your timeline. How would you adjust those percentages, those holdings, those rules to build your own financial residence? That's the real question to ponder.